Hi, we are in the topic of guarantee of profits to a partner. When a sum is given to us, either it will say that the firm has earned a profit for the year or that the firm has incurred a loss for the year. In this video, we will discuss both the journal entries to be passed when the firm earns a profit for the year, as well as the ledger account which has to be prepared where the firm earns a profit and there is a guarantee of profits to any specific partner. Where the firm earns a profit. Example: A, B and C are partners in a firm sharing profits in the ratio of 3:2:1. The partner C is guaranteed a minimum profit of rupees 15,000. Any deficiency arising on this account is to be borne by A and B in 1:1 ratio. The firm earns a profit of rupees 60,000 for the year ended 31st March 2019. So in this sum we find that the firm has earned a profit for the year ended 31st March 2019 of rupees 60,000. On dividing the 60,000 in their profit sharing ratio, which is 3:2:1, we find that A will get rupees 30,000 share of profit, B will get rupees 20,000 share of profit, and C will get rupees 10,000 share of profit. However, C is guaranteed a minimum profit of rupees 15,000. So as per the previous video that we learnt, the amount of deficiency is equal to rupees 15,000, which is the guaranteed minimum profit, minus the profit which is earned by C as per his profit sharing ratio, in this case 10,000. So the amount of deficiency is rupees 5,000, and in this sum they have mentioned that A and B will bear the deficiency of rupees 5,000 in 1:1 ratio. Therefore, the deficiency to be borne by A is rupees 2,500, which is rupees 5,000 into 1/2, and also the deficiency to be borne by B is also rupees 2,500. Let's check out the journal entries that needs to be passed in this case. We need to pass 3 journal entries. The first journal entry will be to transfer the profits from the profit and loss account to the profit and loss appropriation account. Journal entry: profit and loss account debit rupees 60,000 to profit and loss appropriation account rupees 60,000. So the net profits of the firm rupees 60,000 has been transferred from the profit and loss account to the profit and loss appropriation account. The next journal entry is to distribute the profits from the profit and loss appropriation account to all the partners in their profit sharing ratio. The profits are rupees 60,000. The profit sharing ratio between A, B and C is 3:2:1. Therefore, journal entry to transfer profits to partners is profit and loss appropriation account debit rupees 60,000 to A's capital account rupees 30,000, to B's capital account rupees 20,000, and to C's capital account rupees 10,000. being the profits distributed in the profit sharing ratio. So the 60,000 has been distributed among the partners' capital account in the profit sharing ratio, which is 3:2:1. And the final journal entry will be the journal entry for the deficiency to be borne by the guaranteeing partners. For this, we need to credit the guaranteed partner with the amount of deficiency. So we need to credit C's capital account with his deficiency, which is rupees 5,000, and debit the partners who give the guarantee in the ratio in which the guarantee is to be given. So we'll debit A's capital account and B's capital account with rupees 2,500 each. So the journal entry is A's capital account debit rupees 2,500, B's capital account debit rupees 2,500 to C's capital account rupees 5,000 for the deficiency borne by the guaranteeing partners. So these are the three journal entries which need to be passed when the firm earns a profit and a specific partner is guaranteed minimum profits. The first journal entry is to transfer the profits from the profit and loss account to the profit and loss appropriation account. The next journal entry is to distribute the profits among all the partners in their profit sharing ratio. And the final journal entry would be for the deficiency borne by the guaranteeing partners. Next, let's check out the ledger account that needs to be prepared. The ledger account that needs to be prepared is the profit and loss appropriation account for the year ended 31st March 2019. On the credit side, the net profit is brought down rupees 60,000. Now what we need to do is, we need to divide the 60,000 among A, B and C in their profit sharing ratio, which is 3:2:1, and write the amount in the inner column on the debit of the profit and loss appropriation account. If you see here, I have written A gets 30,000, B 20,000 and C 10,000. Next step is add deficiency amount to the guaranteed partner. So again C, I add deficiency, which is 5,000, and take it to the outer column as rupees 15,000. And for A and B, the guaranteeing partners, I will deduct the deficiency which has to be borne by each of them. A is to bear rupees 2,500 as deficiency, whereas B is to bear rupees 2,500 as deficiency. So the net result for A, B and C will be 27,500 rupees for A, 17,500 rupees for B, and C gets his guaranteed share of profit, which is rupees 15,000. So this is the way the ledger account, which is the profit and loss appropriation account, has to be prepared when the firm earns a profit and any one partner is guaranteed minimum profits. In the upcoming video, we will see a few example sums for passing journal entries and preparation of ledger accounts in the situation where the firm earns a profit and any specific partner is given guarantee of profits.